On July 24th, China's largest banks ended retail access to paper gold trading on the Shanghai Gold Exchange. The world's biggest bank by assets is among them. Existing positions must be closed. Physical gold ownership remains open, but leveraged paper exposure through the banking system is gone. Michael Pento has warned this shift could pressure the Western paper gold market. The distinction between paper claims and actual metal just became sharper in the world's largest gold-consuming nation. If precise analysis of gold market structure matters to you, subscribe now so you never miss the next development. Drop a comment with your city and tell me whether you hold physical metal or paper claims. Stay until the end. The implications for price discovery in Western markets get clearer as we go deeper. The Industrial and Commercial Bank of China, the world's largest bank by assets, formally ceased intermediary services for individual clients trading precious metals on the Shanghai Gold Exchange after settlement on July 24th. Other major lenders, including Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank, have implemented the same restriction. Clients received advance notice to sell, close positions, or arrange physical delivery. Once the deadline passed, trading permissions through mobile banking, online platforms, and branch counters were disabled for those products. This is not a prohibition on gold ownership. Chinese households can still purchase physical bars, jewelry, and eligible gold accumulation products or exchange-traded funds. What has been removed is the bank channel route into Shanghai Gold Exchange contracts that previously allowed retail investors to obtain paper exposure, often with leverage. Margin requirements had already been raised sharply in prior months, in some cases eliminating leverage entirely. The July 24th cutoff completes a multi-year process of tightening that began with restrictions on new account openings as early as 2022. The immediate catalyst was heightened volatility. Gold experienced a multi-year rally followed by a substantial reversal earlier in 2026. Banks cited risk control for retail clients as the stated reason. Losses among leveraged participants, including some quantitative funds, reinforced the regulatory caution. The result is a clearer separation inside China between gold held as a physical savings asset and gold traded as a leveraged financial contract through the banking system. Michael Pento, a macro strategist focused on monetary and credit dynamics, has highlighted the potential broader significance. In recent commentary, he noted that if the removal of easy paper access pushes Chinese demand more firmly toward verified physical metal, the implications for global price discovery could be substantial. Western markets, particularly those centered on futures contracts where physical delivery rates remain extremely low, have long operated, with paper claims that far exceed available bullion. A sustained shift in the world's largest consumer market toward physical settlement would test that structure. The Shanghai Gold Exchange itself continues to operate. Its contracts have historically required higher physical backing than many Western counterparts. The bank withdrawal simply closes one major retail distribution channel into those contracts. Institutional and other authorized participants retain access. The practical effect is a reduction in leveraged retail speculative volume flowing through the banking system. For American investors, the relevance is structural. Global gold pricing has been heavily influenced by Western paper markets for decades. Large volumes of futures and derivatives set the reference price that physical markets often follow. When a major consuming nation reduces the ease of paper speculation and leaves physical channels intact, the relative weight of physical demand and price formation can increase. That does not guarantee an immediate price spike. It does change the balance of forces that determine the next sustained move. Central bank buying has already been a multi-year feature of the gold market. Official sector purchases have absorbed significant physical supply. Private Chinese demand has historically been a large component of global jewelry and bar demand. Removing leveraged paper outlets while preserving physical access channels demand toward the metal itself. The volume of paper claims that can be created without corresponding metal is reduced inside the Chinese banking system. The timing coincides with ongoing development of physical-oriented infrastructure. Clearing and settlement systems anchored in physical vaults and focused on delivery continue to expand in the region. These systems operate alongside, and in some cases compete with, the paper-dominated Western complex. The bank decision removes one source of leveraged paper. Volume at the same time, physical settlement capacity is being reinforced. Price action around the deadline has been watched closely. Markets often price anticipated flows in advance. Forced position closures can create temporary selling pressure if leveraged longs exit. And once that flow is absorbed, the longer-term question becomes whether the absence of easy paper leverage alters the demand profile. Physical buyers, who previously used paper as a proxy, may now transact in metal. That substitution, if sustained, tightens the physical market relative to the paper market. Western exchanges continue to function with their existing rules. Delivery rates on major futures contracts remain a small fraction of open interest. The system relies on the ability to settle most contracts in cash or by offset. A structural increase in physical demand from a major region tests the assumption that paper supply can always expand to meet price pressure without corresponding metal movement. American holders of gold-related assets face a clearer distinction. Exchange-traded funds backed by allocated metal differ from unallocated or purely derivative exposure. Mining equities carry operational and jurisdictional risks separate from the metal price. Physical bars and coins held outside the banking system sit closest to the asset that Chinese policy is now emphasizing for retail savers. The Chinese decision does not dictate allocations, but it sharpens the information set available to any investor evaluating the relative reliability of different forms of gold exposure. The scale of the banks involved is material. Institutions with combined assets in the trillions of dollars have removed the retail paper channel. That is not a marginal adjustment. It is a deliberate narrowing of the speculative layer that previously sat between Chinese households and the exchange. The remaining routes are more closely tied to actual metal or to regulated fund structures. Volatility was the stated trigger. The deeper consequence is a reduction in the paper-to-physical ratio inside one of the world's most important gold markets. Michael Pento's warning centers on exactly that ratio in the Western system. If physical demand rises relative to paper claims, the pricing mechanism that has operated for decades faces a test it has not recently encountered at this scale. The July 24th deadline has passed. Positions have been closed or delivered. The banking channel for retail paper gold is no longer open. Physical channels remain. The market is now operating with that new constraint in place. The next phase will show whether the shift remains administrative or whether it begins to alter the balance between paper and physical price discovery on a global basis. Stay with the analysis. The next section examines the precise mechanics of how paper claims function in Western markets, the historical delivery rates that underpin them, the potential transmission from Chinese physical demand into global pricing, and why the current configuration creates asymmetric risk for pure paper exposure. The structural picture becomes sharper from here. Western paper gold markets operate on a fundamentally different structure from physical settlement systems. Major futures exchanges allow the creation of contracts that represent claims on gold without requiring the immediate existence of corresponding metal in vaults. Open interest routinely exceeds available deliverable supply by large multiples. The overwhelming majority of contracts, so, are closed out by offset or cash settlement rather than by taking or making delivery. This architecture provides liquidity and price discovery under normal conditions. It also creates a structural gap between the volume of paper claims and the volume of actual bullion. Delivery statistics illustrate the point. On the primary Western futures complex, the percentage of contracts that result in physical delivery remains consistently low, often well below 1% of total open interest in a given period. The system functions because participants accept cash settlement and because the threat of delivery is sufficient to keep prices aligned under ordinary market stress. When physical demand rises sharply, or when a major region reduces its own paper channels, that alignment can be tested. China's decision removes a significant retail-leveraged paper outlet while leaving physical channels intact. The world's largest gold-consuming population retains the ability to buy bars, coins, and jewelry. What it loses is the easy banking system route into exchange contracts that previously allowed speculation with leverage. Any substitution from paper proxies toward actual metal tightens the physical side of the global balance. The tightening does not automatically produce an immediate price spike. It does change the marginal source of demand that must be satisfied with real supply rather than with newly created claims. Michael Pento has framed the risk clearly. If the Chinese shift encourages a broader preference for verified physical metal over synthetic exposure, the Western paper structure faces pressure it has not recently encountered at this scale. Paper claims can expand elastically. Physical metal cannot. When the demand preference moves toward the inelastic side, price discovery begins to reflect scarcity more directly. The warning is not that paper markets disappear overnight. It is that their ability to set the global reference price without corresponding metal movement becomes less reliable. Transmission into Western pricing occurs through several channels. First, any sustained increase in physical buying from China competes for the same above-ground stocks and mine supply that Western markets also draw upon. Second, arbitrage between physical and paper prices can force adjustments when the gap widens. Third, investor perception of relative reliability shifts. Allocated physical holdings in fully backed funds differ from unallocated or pure derivative exposure. The Chinese policy choice makes that distinction more visible to global capital. Central bank accumulation has already removed substantial physical supply from the market. Over recent years, official sector purchases are typically long-term and insensitive to short-term price swings. Private Chinese demand, once channeled more heavily into paper, now faces a clearer incentive to transact in metal if the goal is genuine exposure. The combination of official buying and a retail preference for physical creates a two-sided absorption of bullion that paper markets must ultimately accommodate or see prices adjust. For American investors, the practical implications are concrete. Holdings that rely solely on paper claims inherit the structural gap between open interest and deliverable supply. Holdings that represent direct ownership of allocated metal sit closer to the asset that Chinese policy is emphasizing. Mining equities introduce operational, geopolitical, and equity market risks that are distinct from the metal itself. The Chinese banking decision does not dictate any particular allocation. It does sharpen the information available when evaluating which form of exposure carries lower structural risk under a potential shift toward physical price discovery. Volatility around the July 24th deadline reflected position closures. Leveraged participants exiting can produce temporary selling. Once that flow is complete, the longer-term question is whether the absence of easy paper leverage alters the demand profile on a sustained basis. If physical buyers who previously used paper as a convenient proxy now buy metal instead, the physical market tightens relative to the paper market. That relative tightening is the mechanism Pento and others have identified as capable of pressuring the Western pricing structure. The Shanghai Gold Exchange continues to function with its existing rules and higher historical emphasis on physical elements. The bank withdrawal simply closes one distribution channel for retail leveraged participation. Institutional access remains. The net effect inside China is a reduction in the speculative paper layer that previously sat between households and the exchange. Globally, the effect is a marginal increase in the weight of physical demand relative to paper claims. Price discovery is not a single venue. It is the interaction of physical transactions, futures pricing, options, and over-the-counter markets. When one of the largest participants in the physical market reduces its own paper speculative capacity, the interaction changes. Western exchanges retain deep liquidity and established infrastructure. Their pricing power depends in part on the assumption that paper supply can expand to meet demand without forcing large physical movements. A durable shift in Chinese retail behavior tests that assumption. The July 24th cutoff is now complete. Positions have been closed or delivered through the banking channel. Physical ownership routes remain open and active. The market is operating under the new constraint. Whether the change remains largely administrative or begins to influence global price formation will be visible in the relative behavior of physical premiums, exchange inventories, and the paper-to-physical ratio over the coming months. American holders evaluating gold exposure now operate with clearer information. The world's largest consumer market has deliberately narrowed the leveraged paper route while preserving the physical one. Michael Pento's assessment that this could pressure the Western paper structure rests on that deliberate choice. The structural gap between paper claims and available metal has always existed. The Chinese decision makes the consequences of that gap more relevant in real time. If this analysis helped clarify the distinction between paper claims and physical metal, drop a comment and tell me which city you're watching from. Subscribe so you receive the next update as physical flows and paper open interest continue to interact under the new Chinese rules. The deadline has passed. The structural test is now underway.